This episode is brought to you by AlphaSense, the AI platform behind the world's biggest investment decisions. The right financial intelligence platform can make or break your quarter. AlphaSense is the #1 rated financial research solution by G2. With AI search technology and a library of premium content, you can stay ahead of key macroeconomic trends and accelerate your investment research efforts. AI capabilities like smart synonyms and sentiment analysis provide even deeper industry and company analysis. AlphaSense gives you the tools you need to provide better analysis for you and your clients. As yet another value podcast listener, visit alpha-sense.com/FS today to beat FOMO and move faster than the market. That's alpha-sense.com/FS.
All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, also the founder of yetanothervalueblog.com. If you like this podcast, it would really mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on either for the third or fourth time, I'm not quite sure which one it is, my friend and the founder of The Science of Hitting and dad-to-be, Alex Morris. Alex, how's it going?
Doing well. Thanks for having me. Enjoyed your podcast with Bill Brewster, our mutual friend. Anybody who hasn't listened should go listen. It's a good pod.
I appreciate that. That's on a completely different feed. It's on the Business Brew feed, but please go check it out if you haven't. Before we get started, I'll just do a quick reminder to remind everyone, as with every podcast, nothing on this podcast is investing advice. Always true, but particularly true today. Alex and I don't have a particular stock we're going to talk about. So who knows? Maybe we'll talk about 500 different companies. Maybe we're long all of them. Maybe we're short all of them. Who knows? But just remember, nothing on this podcast is investing advice. Please do your own work. Consult a financial advisor, all of that type of stuff. So, Alex, the reason I wanted to have you on, aside from third or fourth time guests, I like having you on. It's fun. People seem to enjoy it based on our Twitter feed, is you published this great post almost a month ago now on letting winners run. And when you did, I instantly emailed you and said, hey, I've been thinking of something similar. I'd love to have you on to just discuss the concept. So people who haven't read it, I'll include a link to the Letting Winners Run post that Alex posted in the show notes. But I just wanted to turn it over to you maybe to start. Just describe the concept of letting winners run, why you did the post and everything, and then I'll follow up with questions and everything.
Yeah, well, first of all, obviously, thanks for having me. I always enjoy being on. I think the post is, in some ways, it was kind of a culmination of thoughts I've been having for a while now, which kind of aligns to what we're seeing in the market generally in terms of, a handful of very high-profile names that have had strong runs for, a very long period of time now, and people thinking about this question of when to sell, do you ever sell, that type of thought process or questioning. And, it aligns with some other posts that I've written recently. And probably the most notable one, which ties into letting winners run, is this idea of a coffee can portfolio, which goes back to an investment advisor, I believe it was in the 50s. Long story short, they would give out stock recommendations, and he had a client who would take those recommendations and put a fixed amount of money into all of them. I think it said $5,000. But the one thing that this client did not do was ever sell any of the stocks when the investment advisor said, hey, now's time to take the profits and to invest in something else. And when they looked at this client's portfolio after a period of, 20 years or so, let's say, what they found was a decent number of the positions were, basically immaterial, worth $1,000, $2,000. They'd lost a lot of money. There were a handful that were worth $50,000 or $100,000. So it made 5, 10x or more. And then I believe there was 1 or 2 positions that were worth, north of $500,000. So, the advisor who wrote this post basically talks about the idea of this client who had, what seems to be a much more simplistic approach to investing, how his outcomes were much better than what they achieved by spending all their time working very hard to decide when to buy and sell things. And it aligns with conversations that I've seen over and over again, notably in The Art of Execution, which is a good book written by a gentleman who ran a Best Ideas Fund. He comes to similar conclusions in terms of all the managers that performed the best had a handful of positions that had grown to be very large in size. There's a great quote from Gavin Baker along the same lines. So it's just something I've seen over and over again from investors that I respect, who are clearly intelligent and who have been playing the game for a long time. So I find it very interesting to think about.
That's great. So you did mention Best Idea Funds, and I think that's actually one of the things I had in my mind when I was emailing you. But so I want to come back to that. But let me ask you my first question. Like, in 2021, one of the most frequent things, and I think I know the person who started the saying, but I won't call them out, and not call them out. I won't identify them because I don't know if they'd want to be identified. But I heard from multiple investors a story that would go like this. What's the biggest mistake Stanford ever did? The biggest mistake Stanford ever did was in 2004, 2005, they had a big position in Google and they sold all of their Google stock. And if they had just held that Google stock, the Google stock would be worth $1 trillion. Or if they, another that comes to mind recently is Bill Ackman. He's been criticizing Harvard nonstop. I'm not trying to turn this into a political podcast, but one of the things he criticized them was he gave them equity in a smallish Asian startup. And he said, hey, I think this is a killer. I'm giving you this equity. You cannot sell this, right? If this equity, like I think the story is if it goes up more than 5 times, I get to choose the proceeds of whatever above 5x it did. And the equity went up 20 times and it turns out Harvard had sold that, right? So I would hear these stories of people saying the biggest mistake Stanford ever did was selling Google in 2004, 2005. And that is true, but I do think there's a lot of hindsight bias there. And I can tell you a lot of the people who were saying that in 2021, they were holding these huge winners, that with the benefit of hindsight, we're really benefiting from the ZERT bubble. We're way overvalued. It just, in 2022, it really went against them. And that's not to say these people weren't smart. The ideas weren't great. Maybe they come back. Who knows? But, I think, again, with the benefit of hindsight, they'd probably look back and said, ooh, maybe I should have trimmed a little bit of that. So I guess my first thing would say, we can talk selection bias, but what would you say to people say, hey, Alex, you're coming and telling me this, and we'll talk Microsoft, we'll talk all these, but you're really using hindsight bias here, right? If I had said the same thing about holding Enron in 2000, and I was like, the biggest mistake would have been selling Enron in 1998. Well, the biggest mistake would have been holding Enron in 2000 because it was going to zero real quick. And we can point to dozens of other examples. Sears was the best performing stock of all time. What would you say to that kind of selection hindsight bias pushback?
Yeah, in the article, I should mention that the client from the coffee can portfolio, the position that was largest of all was Xerox. And, obviously over time, that eventually got to a place where you would not have wanted to have had 80% of your portfolio in Xerox. So it's, very specific. It aligns with that example perfectly, right? And I think I wrote about this as well as it relates to Coca-Cola and Berkshire's investment, which I find fascinating that I believe Buffett started buying in 88 or 89. He bought his last share in 94. At the peak, it was worth, I believe, 35% of the equity book. And he has not bought or sold a share once in the past 30 years, since 1994. And I think my takeaway from it is less so about has Coca-Cola been a great investment or not. And there are obviously lessons to be learned there. It's more so just getting into understanding the mindset of someone who's able to do that, because that's very far away from how I think people probably approach investing generally, especially smart people, right? People who spend a ton of time working at investing and are thinking of a portfolio as a collection of securities with implied IRRs over, some time period, 5 years, 10 years, whatever it may be. And they kind of back into sizing and selection based on that criteria. And it's interesting to think how different approaches may approach that question very differently and how it kind of works out. So it's less of this is the best way to invest, more of it's very interesting to see this very different style of investing from what you normally see and how it can work when obviously it works well, right?
Just on the Buffett piece. So one of the things, and you mentioned this in the article, so I'm very much stealing what you were saying, but you mentioned, hey, it's interesting. Buffett did this and he never bought or sold a share, but he did have, I don't want to say other sources of income because it wasn't Buffett who had the other sources of income, but Berkshire had the insurance float, right? Every year, they're great. They've got great advantage insurance businesses and they started buying more businesses. So every year they had more cash coming in. And you mentioned the advisor who kind of just coffee can portfolio it. I think one of the things you said for both of them is they could coffee can a little easier because they had more income coming in on the side. So they knew, and that's great. But I think, my pushback there would be if you're a professional investor, you're an aspiring professional investor, like you have to look at your portfolio every day. Like it is the only thing that you're going to make. And, the coffee can portfolio sounds great. But my second pushback would be, hey, if you need this other source of income to do it, like you're kind of saying you need a put option on yourself almost, or you need, you're kind of you're taking under optimization in your portfolio because you've got other income, and even if you've got other income, like if you were someone who was fortunate enough to save, let's say $10 million and you have $100,000 per year income, like $100,000 per year is a decent chunk of change, but it pales in comparison to the $10 million. So if like one stock had run up to 80% of your portfolio, it would be kind of tough to be like, well, I've got $100,000 of income, but I've got this one $8 million position. So I guess that would be my second pushback. Like, is this really optimized investing when we're looking and saying, hey, it only works when you've got other income sources to go on?
Yeah, I mean, I think that my question back would be, what does optimize mean, and what are you trying to optimize for? And I think that's where it gets grayer, right? And that's where we get outside of the black and white thought process of what it means to be an investor. And I think that's where the conversation gets messier, and you get into these questions of, what part of this is quantified IRRs and what part of this is faith in a management team or a manager, faith in a business, faith in a TAM. These are things that you can have thoughts on, but obviously can't know with any certainty. I think the cash flow consideration, Warren Buffett in 2000 or whatever year we want to pick during that time period when the position got to a very, very large size, I think you could have very, very reasonably assumed that if you looked at over the next 10 or 20 years, that even if the position underperformed by, some amount of margin relative to the index or another opportunity on a pre-tax basis, let's say, he had reason to believe that the position was going to become much smaller over time. Now, does that justify the decision? I don't think so, but it does make the decision different than if you were sitting there with a portfolio and you were thinking, I need to take cash out of this every year for the next 20 years. I think that would impact your thought process on what was the appropriate thing to do. And obviously there were other considerations there, like being on the board of directors, et cetera. But yeah, my main takeaway on most of this stuff is it's ultimately a personal decision based on kind of your desired way to approach the game, which obviously should hopefully align with something that can work well over time. But then structuring your process and decision-making to align with that.
And now a quick break to remind you that this episode is brought to you exclusively by AlphaSense, the AI platform behind the world's biggest investment decisions. AlphaSense gives you the tools you need to provide better analysis for you and your clients. As yet another value podcast listener, visit alpha-sense.com/FS today to beat FOMO and move faster than the market. That's alpha-sense.com/FS.
Let me ask one more question. So you have, actually, I'm going to ask a lot more questions, but just one more. The best fund managers, and again, I want to return to the concept of best funds, but what he said is, hey, I know of no great investors who haven't, had one or two big winners that grew to a huge percentage of your portfolio. And I guess I would just ask, how much of that is resulting or selection bias, right? Okay, cool. If we start with 2,000 managers and 40 of them have these, mega home run winners, yes, your 40 best investors had 40 mega home run winners, but there are 1,960 others, and maybe they weren't as smart. Maybe they were just as smart. Maybe they were smarter, but they didn't have the mega winner. So you don't point to them. Like, how much of that is just, it's, you had 2,000 monkeys and 40 of them threw the stock and hit Apple or Tesla or Netflix, and their returns were incredible. But the 1,960 of them threw the stock and hit Cisco or Oracle, and I'm just naming names, but stocks that didn't have quite as good of returns. Wells Fargo in 2014 is one that I really like to mention because I can go back. I put a post up. We can probably include a link to it as well. Warren Buffett, as recently as like 2011, 2012, was saying Wells Fargo was his opportunity cost. Every time he thought about buying more of a stock, he would just say, why don't I just buy more Wells Fargo? And 2 years later, the Wells Fargo scandal comes out. The stock's gone nowhere for a decade, and Buffett's now sold all of his Wells Fargo. So I just wonder how much of this is selection bias. So I guess I'll turn that over to you.
No, I think it's a fair question. I mean, I think there's other valid, for example, art of execution is based on, he managed his fund, I think it's over a 7, 8, 9 year period, right? So we're not talking about, it isn't like some multi-decade study covering, I wouldn't say it's not the most, you can ask questions about the results of the study, let's say. But again, I think the bigger point is, one, obviously avoiding extremes and just thinking about what is kind of the lesson here. And again, how does it, people can look at their own portfolios, how does it compare to your own portfolio construction? As you look at the value of your portfolio, let's say, what percent of it is from companies that have been in there for more than 3 years, more than 5 years, whatever it may be. And again, is that even a desired outcome or condition that you want your portfolio to have? I mean, that's a question for people to answer. For me, it is, but it's because I'm trying to invest in a certain way. So again, it's always up to the people for them to decide what they think is the most appropriate way to invest their money based on their own considerations, right?
Just on, if you're looking for the letting winners run strategy, right? Right now, if you had invested the past 3 years, the best answer would have been either buy, Apple, Microsoft, or an AI winner. NVIDIA would have been a great one. But it does strike me, the example you gave for Buffett was Coke, and the example you gave for kind of a retail person who was coffee canning it was Xerox. And the reason that strikes me is Coke and the other stock I named for Buffett, Wells Fargo, those are timeless businesses, right? Coke has been around since the late 1800s. I think it's pretty safe to say people are going to want to drink something that they enjoy. You know, we can talk about sugar issues and all this sort of stuff, but I think it's probably pretty safe to say 200 years from now, people are probably going to be drinking Coke. Maybe it'll be a Diet Coke with a better, zero sugar, but that brand is pretty timeless to me at this point. Wells Fargo banking, what's the joke? It's the second oldest business in the world. Like, you can feel pretty comfortable 200 years from now, there's going to be banking. Maybe the nuts and bolts changes, but maybe it doesn't, right? Like, I think crypto has taught a lot of people, hey, the banking system is pretty nice version. So Buffett, like his forever businesses, the businesses he's let run, if you think about Geico Insurance, American Express, credit card / banking, the businesses he's really let run have been forever businesses. The most recent example is Apple, which that's interesting because it maybe not be forever business, but it's probably more forever than some of the Magnificent Seven, I would probably say. But anyway, he's got these forever businesses that are timeless. The example you cited of the coffee can portfolio, the big winner there was Xerox. And a lot of the big winners, when I think back to the Google examples, the studies I said earlier, or the people earlier with Google, they were not timeless businesses. And I just want to ask you, do you think there's something to that? Like Buffett was choosing forever businesses for these letting winner runs example versus, maybe an analyst or someone else is choosing a business that probably's got a great 5-year outlook, but maybe if you looked out like 20 years, you could say, hey, there might be some terminal value risk.
I guess it's really static because it always fascinates me from when I did work on Fever Tree, which is basically a cocktail mixers business. They make tonic water and things like that. Fever Tree's sales volumes last year was 700 million units, and Coca-Cola's daily unit volume is 2 billion units around the world, which just gives you a sense for the scale of that business. It's fascinating. But yeah, I think the point you're making is spot on. I mean, Buffett talked about this explicitly at some of the annual meetings in terms of how he thinks about security selection and position sizing. It's very much framed around certainty of outcomes as opposed to, again, like an IRR driven framework, or you can obviously make some adjustments for risk reward, but he very much leads with what's my level of confidence in terms of where this is going to be 5 to 10 years down the road. So I think it's a very fair point. The other part of it is there's this article from a couple of years ago, which we've been talking about hindsight bias and resulting, but about this, I believe it's a dentist or an optometrist in West Palm who has this portfolio that's worth a ton of money. And, he had companies like Cisco, companies like General Electric, but they just shrunk to an immaterial size over time as those businesses did not perform particularly well. But he also had a $5 million investment in Heiko dating back to, I believe it was the mid 80s. And he knew the people there personally, the Vendelsons, I believe their name is, and he had done scuttlebutt that gave him a lot of confidence in the business. And that $5 million investment is now, or at the time when I wrote about it, was worth more than $1 billion. And, I think your question's a fair one. I think he also probably recognized that the company was well positioned in that part of the value chain and that they had opportunities to grow over time through M&A. And, it's only been 30 or so years, but so far he's looking pretty good on that call. So again, I don't think any of it's black and white. And maybe it comes down to a question of, as positions run and as they become larger and larger percentages of your portfolio, how do you think about sizing? Maybe the answer isn't to just let them run forever and never touch them. Maybe it's to trim, but with less aggressiveness than maybe you would if you were purely looking at things on a, next 12-month PE or something like that.
That's great. Let me ask one more here. So right now, I think when people think of a letting winners run forever, and this is very related to the terminal value question, people think a lot about Netflix, right? And that's interesting. I mean, Netflix is a great company. I don't think there's any doubt about that. But if I just went in media 10 years ago, if I was like, hey, what's your forever business in media? People said, oh, that's easy. The cable networks, right? Paramount. I mean, they were literally the greatest business models anyone's ever imagined. Whether people watched them or not, they got paid, $2 per month, and no CapEx, incredibly high returns. They were fantastic, great economies of scale. So, if you were a cable network, you and cable network one, and you bought cable network two, and you could go to your cable distributors and say, hey, now more people watch us. We used to charge you $1 per month for each of these. You got to pay us $1.25 per month for each of these, because now we've got even more things. So it's just curious, like 10 years ago, you would have said cable networks. 20 years ago, you would have said Blockbuster. You would have said, hey, these guys have this great brand. They've got the great this great mode in terms of returning. They have scale purchasing power when it comes to buying VHS. 30 years ago, you would have said newspapers. And it does just strike me like media is a forever business. But just when I was thinking about Netflix, I was kind of struck by how much the forever business in media has changed over the 10 years. I don't know if there's a question in there, but I just did think that was interesting. So I just kind of want to toss that over to you as you think about these letting winners run business.
Yeah, I wrote another article about this recently where I kind of led off with this quote from Ken Langone, who's had big investments in companies like Eli Lilly and Home Depot for a very long time. Obviously, have been fantastic investments. And when he was asked on CNBC and his selection process of investing, he basically said it's all about the people. And I think that's a hugely important part of all this. And again, it's messy because this is not investment people, smart investment people. I think they do not like these things that are a little bit harder to get your arms around, but which are hugely important over time. And I wrote about this in the context of Microsoft and cloud computing and Satya Nadella, and it's very clear from looking back on the story that if he had not been put in charge of server and tools and then eventually became CEO of the company, you'd probably be looking at a very different story today than what actually played out. And I think part of being a minority investor, and particularly a long-term investor, is doing the best job that you can to try to piece these things together as they happen. You may not get there until 3 years after major developments or something, right? It might take a lot of time. In some cases, it may not even be something that you can ever truly get your arms around, even with doing a good amount of scuttlebutt. But to the extent that you do find these things, I think you have to put a lot of weight on them as opposed to, again, just going to more quantitative driven approaches to how am I going to think about position sizing and security selection.
So that's another interesting one. So just on the management piece, like most of these, the Magnificent Seven, I think most people today would say have generally top tier management, right? I guess the two things that are interesting there, if you're letting winners run forever, like eventually you do have to think about a management change. But just if I even took the Magnificent Seven, right? 2 years ago, if you and I had been having this conversation 18 months ago, Facebook stock would have been at 150 on the way to 100. And, Facebook was burning money like crazy on Meta Labs and everything. I don't know if people would have said Zuck was this visionary CEO at the time. I know a lot of people were like, hey, I wrote articles. I mean, I wish I'd done this, but I wrote articles. I was like, hey, this is the guy who took Facebook from mobile to desktop. From desktop to mobile. He bought Instagram. Like, you've got to give him a little word. But I know a lot of people were like, this is insane. This is, he's burning all this money. I don't know a lot of people who would have put him in that category. Microsoft is one. I think even when you bought it, at the time, Ballmer was running it, right? And Ballmer, I think the best thing that ever happened to Microsoft is they made the switch to Satya when they did. But if they had made it a few years later, like we could have really been talking about terminal value there, right? So I guess my two questions on management, and we'll go back to Microsoft in a second, like how important is management when you're letting these winners run? Because management does change over time. And it does strike me that the same management team can get viewed very differently. Even with Zuck, inside of 18 months, he can get viewed very differently.
Yeah, I mean, I'd say for one, you certainly need to have your own perspective on the answers to these questions, and if market price action is going to greatly impact your views on something like this, then that's probably going to be an issue. So that has to be addressed, at the investor level. In the case of Microsoft, is a very fair point. And for me personally, it started out as a very traditional value investment, and I think it stayed that way for a long time until the call it 2015, 2016 period, where a stock that had been trading at, let's say 10 times for many years now found itself trading at 20 times and, started to look expensive on how people had viewed that business for some time. In hindsight, that was at $55 a share or something like that. And, today it's at 400 or whatever it may be. And that some of that has been due to multiple expansion, but a very significant part of it has been the earnings have gone from 250 to, something in the $15 range or whatever it is. So, or getting there. So, I mean, I think that's a good example of, again, continuing to follow the story and learning over time. I can explicitly remember when Satya Nadella was named CEO, there was a common response, particularly in the financial press, that they hired an insider and this was not going to work and they made a mistake. They should have went with an outsider like Alan Mulally, and that this was probably the end of, or things were going to continue to get worse for Microsoft. And I remember explicitly reading a blog from someone who had a smaller software business that was acquired by Microsoft, and he worked under Satya Nadella after that deal. And his perception was that what was being said about Satya, to the extent things were being said about him, was exactly wrong, and that he was the perfect person for this position, and that he was going to be able to implement pretty significant change in terms of where the company's focused. And I think if you align that period of time with what he writes about and hit refresh and you piece it all together, again, with the benefit of hindsight, you start to really understand how important it was that he was there. So, there's no question that management is hugely important. As I kind of wrote here recently, I think the arc of the quality of the business bends over time to the quality of the management team. And I've used something like AWS, obviously, is a very common example at Amazon. And I think as an investor, you have to do all you can to see where the crumbs are at and what they're suggesting in terms of, is this a very good team or is it a team that, is lacking in some way? So a notable example recently, at least in my mind, is when I see someone like Gavin Baker in an interview say that Google has been horribly mismanaged over the past couple of years. I think he understands these things. He understands that company in particular much better than I do. So when I hear someone like him saying that, it would strike a chord with me, and I would think seriously about what that means, and to the extent I could get the answer myself, whether or not that was right.
I just, one thing you said in there, you said the arc of the business bends over time towards the arc of the management team, or I think you said the quality of the management team, which is interesting because I would have a conflicting view and a similar view. Like, the conflicting view is that is the direct opposite of Warren Buffett's when a management team with a good management team meets a bad business, it's the business that wins, right? That's the exact opposite. But at the same time, I would say, hey, you invested in Microsoft in 2012, right? If you bought Microsoft in 2012, Azure and all the online tools, Microsoft 365 subscription as a service, you could not underwrite that. You didn't even know about that. A lot of people have ridden Amazon, for the past 15 to 20 years. If you did that, AWS launched in 2006, 2007. It was not a needle mover, right? You bought it because you said Amazon, dominant retailer, best in breed management with Jeff Bezos. And it is just interesting. These guys pulled, that's literally pulling a rabbit out of your hat, right? If you bought Facebook 10 years ago, you bought because you're like, Zuck's a killer. And you didn't have, hey, we buy Instagram for $1 billion and WhatsApp for 33. And these are like two of the best acquisitions of all time. But it is just interesting. These are management teams that, as you're saying, are bending the business towards their arc in direct conflict. I guess my off the spot question would be, is that something unique about big tech where they can quickly pivot and the management team, because the scale is so infinite? Because I would say like Steel, which is known as not a great business, right? Even if you've got the absolute best manager in Steel, and maybe this is disproved by like the Nucor example and everything, but even if you got the best management team in Steel, you can't really pull a rabbit out of your hat, right? Cool, we bought a specialty steel company. Your multiple's going from 5 to 5.5. It's not like you're going to grow like crazy. Is it something unique to tech, or am I kind of missing something?
Yeah, I would say the key word is bends, right? And you don't want to test the theory by picking a very crummy business and then saying, okay, this guy's the best manager. Let's see if this works out. Preferably, you're gonna pair a very good business with a very good manager, and I certainly would argue that. Again, part of the reason why I invested in Microsoft in the first place is because there were components of that business that I thought at the time were very, very strong and were, they had challenges ahead for sure, but the positions that they held in Windows, the position that they held with Office, the position they held in server and tools, while there were certainly challenges ahead, and as always required effective strategic decision making and management to get them to where they needed to be 5 to 10 years down the road, I still thought the starting position was very, very strong. And obviously, we can look at the P&L or the cash flow statement at that period of time, the balance sheet, et cetera. They had a lot going for them, even during a period of clear stress. Obviously, we could say something very similar to with Zuck and Meta, in late 2022. A lot of things were going against them. Businesses are now doing particularly well in some ways, huge FRL losses. But when you put it all together at the end of the day, it wasn't like they were fighting for solvency or something. So I think that's a huge part to add in here to the discussion.
Let me so on the pulling rabbits out of your hat, right? One of the things I have had the most trouble with in my career is picking losers, but also thesis drift. Like most of my big losers come from thesis drift, and the thesis drift generally looks something like this. Let's use a very simple example. Hey, the stock's at 20. I'm buying it because they're undergoing a strategic review. I think this strategic review is going to be fierce, and I think it's going to go for 30, right? And then 6 months later, hey, the strategic review failed because I think the company wanted 30 and nobody would bid higher than 27. I think they were wrong. The stock's at 15, and now it's starting to look cheap, and I think we'll have a strategic review again in 6 months. And let's go forward 6 months. The stock's at 10. Yeah, the industry's not doing well, but now it's cheap, and I think they're going to be buying back shares. And then let's forward 6 months later. The stock's at 5, but this is option value at this point, right? So I've thesis drift the whole way down. I guess with Microsoft, and I wondered this, and I think several people wonder this, and you could wonder this with someone who bought Amazon a few years ago. Pick your Apple at 10 times PE 6 years ago versus Apple today are very different stories, right? The thesis drift where, hey, Alex, 12 years ago, you bought Microsoft because it was at 10x PE and you saw these great businesses. And now you have very successfully held it the past 12 years or so. But at some point, this became thesis drift, right? You had I am buying this as a value metric. I am buying this as a value play. And now it's a GARP play. And now it's a take over the world play, right? And in my thesis drift case, it's negative, right? You should have and in your case, it was positive. But I could also paint hey, we did the Stanford don't sell to Google thing. And we went from 10 to 30, and then we didn't sell. And then, how many people have shown you a stock of Oracle or even Microsoft? It hits a share price in 2002. And if you held it from 2002 to today, you've done decently given the recent, but from 2002 to 2016, the stock is flat, right? It takes a while to really backfill that. When does that come into play? I don't know if any of that made sense.
Yeah, I think that's when it all matters, right? This is the question to be answered. And I think again, it comes down to your assessment of the position of the business, obviously some thoughts on TAM or something like that. How big can this be over time? What's the opportunity? It comes down to the quality of the management team, competitive position, et cetera. To put a very specific example on this, if Satya Nadella announced he was retiring tomorrow, that would be an announcement that would be problematic for me that I would need to seriously think through in terms of my level of confidence in the business as we looked out 10 years and what that meant for position sizing, even if on the margin, right? So that would impact my decision making. My hope is that he's still relatively young and that he decides he'd rather do nothing else in his life besides stay here for a very long time. But yeah, those are all relevant considerations. And again, I think some of the trouble with some of these things is when it gets so black or white and you have to live in one all-in camp versus the other all-in camp. You can always make positions smaller. You can do things on the margin that maybe you're not perfectly aligned with one worldview, but that again, bend in that direction. And I think that's really where my head goes. It's how do you get yourself in a place where you can make a little bit longer term and really not be in the position where when you find the best management teams and the best businesses that you're capable of finding, you push yourself out of them purely based on, traditional valuation metrics. And there is a limit to that, but I think it's, if the past 10 years or so are any indication, it can also be the cause of very significant stress when you look back. And again, some of the quotes that I mentioned at the outset, right?
Let me give you another just counterexample. 3 years ago, so 2021, if you and I had this conversation, Disney, one of the best businesses ever. Iger, I believe Iger he retired in 2020, but the after effects of it hadn't really started seeping in. And this is a great business, right? Disney Plus is a killer. Look at Marvel is the most successful franchise in history. Star Wars, okay, the last Star Wars film wasn't great, but they got Mandalorian. I'm pretty excited about the future there. We would have been really bullish. Parks are great. ESPN struggling, but they found a bottom probably, and they still got all these great assets. Disney Plus is thriving. Iger was one of the best media CEOs of all time, right? A lot of people would be running them in the coffee can portfolio as they have for the past 50 years pretty successfully. But, if you've studied Disney, also over 50 years, if you close your eyes, it did really well. But there were a lot of down peaks there, right? There's the early 90s. There's the mid 2000s. There are a lot of bad places for Disney. And I guess today, if we came forward, the whole story has changed, right? Everyone points to Disney and be like, oh, those guys are effed. Theme parks are going to be good. I'm not calling for them to go bankrupt, but they're caught up in these crazy culture wars that we certainly wouldn't have been talking about in 2021. The state of Florida against Disney. Who would have imagined that in 2021? That's crazy. Disney's the biggest employer there. Nobody would have imagined any of that. Iger's come back, but now people think Iger's crazy. The whole strategy, I think a large part of his success failing was, part of it's on his successor, but a lot of it is he was actually executing the Iger strategy. And in hindsight, it wasn't a great strategy. Iger looks way worse. So we've got this business that was forever with the best CEO out there. And now just 3 years later, you're like, hey, this business sucks. And Iger is a fool. I don't know. It's crazy how time shifts. So I guess just on that, do you have any takeaways from that? Would you say the view 3 years ago with Disney and Iger was actually more close to reality than the view today? Do you think like ZERP and just post-COVID effects were actually masking some real weakness at Disney and Iger? Any takeaways from that example?
I think my biggest takeaway, and it mirrors something that I saw at Walmart through the 2010s.
That was another example I had on my list. Absolutely. Yep.
Particularly after Doug McMillon became CEO. And I think in hindsight, I mean, at the time as well, but in hindsight, I think the strategic decision-making under his leadership, in my mind, has been very, very good. And he's got the business in a much stronger place than where it was when he got there. The problem is it required many, many years of significant P&L investment, particularly in terms of getting some of the omni-channel stuff in place that the company had effectively missed in prior years. And playing catch up it took a lot of time and it cost a lot of money. And I think Disney is a very similar story. At the end of the day, it was never realistic to think that they'd get to where they need to be in 24 months in terms of D2C. And, the levers that need to be pulled in terms of making this a sustainable business long-term are still being pulled today. And it's far from assured that they're actually going to work. On the other side of the ledger, you had a business with very significant exposure to linear TV in terms of the P&L. And, if you go back 3-4 years ago, I think the peak pace of pay TV sub losses, if you look at someone like Comcast, I think it was only 2 or 3% at that time. If you look now, last year, Comcast pay TV subs in the U.S. declined, I believe it was 13%. So we've seen a significant acceleration there, and that has obviously further pressured the P&L. So I think, the takeaway in my mind, it would go to this idea of when you're seeing disruption and you're seeing a business that is going to have a lot of pressure in terms of its evolution. The thing to do is to be careful in terms of buying just because the stock's going down. It's optically getting cheap to the extent that it even is. In this case, the P&L obviously got hurt in a pretty significant way. But yeah, I think that's one of the bigger lessons. And Buffett talked about this as it related to precision cast parts when someone asked if the deal was basically a bad deal. And he said, the history of Berkshire is we buy things and the portfolio has a way of kind of naturally solving for itself, with a Geico that was worth a handful of billions of dollars being worth many multiples of that over time as the business continues to grow and improve. And the things that don't work kind of just fade away and become a smaller piece of the portfolio, which, I think that's part of the lesson that I take away from this, and which, by the way, kind of mirrors what you see from the tough competitor in terms of the index.
It's interesting, just like, there's a famous loser, average loser saying, right? The funny thing about Buffett, now, he's the greatest, right? Every time I run this series every now and then called Trite Buffett Quotes, because he says these things that sound so trite, and then as you think about them, you realize just how much wisdom there is. But one of the interesting things is when you buy the whole business, there's no losers, average losering, because you've already bought the whole business. And like, it actually works really well with a letting winners one mindset, right? Because if you were like, hey, I'm really good at this. If I buy 10 businesses, 4 of them flame out, 4 of them are average, and 2 of them are grand slams. That's actually an incredible slugging percentage. And if you're buying the whole businesses, there's no chance to average down. So you just get that grand slam. So it's kind of interesting. You mentioned Buffett. I also think it's interesting, and this relates to what you were saying, right? It's a little bit losers, average losing, but when things get optically cheaper, I know my first instinct is to buy more. I loved it at 400. I liked it at 400. I should love it at 300, right? I think one of the interesting things is Buffett has been very able to kill his best ideas, right? Coke stock is flat for 15 years and he's never bought more Coke. Wells Fargo, he's talking about it as his opportunity cost in 2011. He never buys more, as far as I know, and after the scandal comes out, and eventually he sells it all. Maybe he was too late to sell it, all this sort of stuff. Airlines in 2018, he's buying all the airlines on the oligopoly story, basically. And in 2020, COVID hits and he just rips the Band-Aid off and sells them all, rightly, wrongly, who knows. But he's been able to pull the plug. And I just wanted to ask, like, when do you know to pull the plug, right? Because again, there are business management teams, even if the management team doesn't change, like, as you said, if Satya left Microsoft, that would be a, hey, maybe it's time to trim this thing moment. But management teams, our view of them can come and go. 3 years ago, Iger's a hero. Today, he's a villain. 2 years ago, Zuck's a villain. Now he's a hero. When is it? Like, how do you know it's not just a bump in the road? It's time to get out fully or trim, or how do you know it's not time to add? Because, we've seen these great businesses, Netflix in 2022 reports a weak quarter, and Ackman flips it from, he buys it at 300, he flips it at 200 2 months later, and 2.5 years later, 2 years later is at 600. Anybody like a triple? So how do you know it's not a bump in the road to be taken advantage of versus time to pull the plug?
Yeah, I think the answer is it just simply comes down to your own assessment of the situation, which is not a very helpful answer.
I need hard and fast rules here, Alex. I need hard and fast rules. I'm trying to improve.
I mean, as I'd have to go back and read the post that I wrote at that time, but I did buy more Netflix around that time. And, I think part of my assessment was the long-term opportunity as I saw it was still intact. The pricing power of the offering was still intact. The idea that their position in the industry was seriously under threat to me did not, particularly pass the smell test. Maybe I benefited from, although I have not benefited from owning the stock, maybe I benefited from owning Disney in terms of, I think I had some appreciation for how difficult it truly was going to be to try to scale globally, and how the ability and willingness to go after that opportunity was going to be something that very few people may be able to go for. I thought Disney would be on that list. I'm less sure of that today than I was then. I never believed that a few of the other smaller players would really have what it took to go after that opportunity. On the flip side, you look at something like cable, which I own Comcast for a very long time. I own Charter for a shorter period of time, but I think for me that situation has got to the place where the thesis that I was relying on, which may be valid at the price that it trades at today, was just so different from the reason I had bought the stock to begin with. And I think in those situations, for me at least, I've got to a place where I think I need to let them go, and then maybe take a step back, take a breather, and then kind of just reassess going forward. And that might mean buying again in 3 months, might be buying again in 3 years, and might be never buying again. But for me, that situation felt different. But all I can say is that it's a one-off. I just don't know if there's any, the one blanket rule I walk away with from 10 plus years of doing this now and doing the opposite when I was younger is not just reflexively buying more when it goes down. That's what I used to do. And it can work out when you're right about the business. And I've had a number of situations where that did not work well.
You mentioned Netflix. Your confidence was the long-term story, the moat, all that. The one, we've generally been talking about this, I think, with a great business mindset, right? We've mentioned the tech companies, we mentioned Walmart, media companies, which might not be great businesses anymore, but for a long time were great businesses. There's another big winner category. Now, the wins might not be quite as big on the shorter term basis, but what's the best performing stock over the past 50 years? I believe it's still Altria, right? Tobacco company. And you could probably know, maybe not 50, even 50 years ago, you probably knew that less people would be smoking 50 years from then. And today, so I guess my question, coal companies over the past 3 years have been, I would put the chart of coal companies against any chart, right? These things have been home runs. Now, there's tons of things going on with coal companies, right? They were all highly leveraged. They had a cyclical boom, but these things have been great, and they might be really good long-term holds on a similar, I love the phrase, it's a sunset industry, but what a beautiful sunset it could be, right? So I guess I just want to run by you. We've been talking about this through a great business lens. I don't think it's what you do. Everybody needs to know what they do, but I mean, can you apply the same principles to kind of the declining industry with the beautiful sunset principle? Is that just someone else's game? Are there no lessons to learn there?
No, I think you can. I think it somewhat applies to the cable discussion as well. Where my head goes on those stories, and to the extent this is applicable, I think would probably be more applicable to the tobacco story, is how much of the TSR, how much of the return that I expect over time is kind of the organic growth of the business, which is a capital returns driven part of the outcome, which there's nothing wrong with that. But I think for me, it does impact how I think about what's a reasonable position size. And this is another part of the discussion that I should have probably brought up before. I think another thing to be said for a portfolio that has capital coming in versus one that's more static is it makes it more difficult in my mind in terms of in terms of position sizing and letting things run. Let's say, for example, you have something at 5% of your portfolio. You think it gets unfairly hit. You still think it's a great business. You take it to 7, 8, 9%. If it does really well from there, a few years later, it might be 15 or 20% of your portfolio, which is I would think most people would agree is a fairly sizable position. And, that just feels different than if that position was 8% of your portfolio after a strong run. So I just think that's also part of this discussion is thinking about position sizing. If this works, where is that going to get me to? And then what kind of outcome will that lead to? So for me, I bucket them in terms of what is driving the TSR. And as I think about how much, the portion of it that's dependent upon capital returns or, effective timing to some degree, how do I think about that when I'm sizing the position?
And now a quick break to remind you that this episode is brought to you exclusively by AlphaSense, the AI platform behind the world's biggest investment decisions. AlphaSense gives you the tools you need to provide better analysis for you and your clients. As yet another value podcast listener, visit alpha-sense.com/FS today to beat FOMO and move faster than the market. That's alpha-sense.com/FS.
The one other area I've been looking at and thinking a lot about recently, and I think this is in part because, for a long time, Buffett's opportunity cost was Wells Fargo. And today, it's not quite as bad as it was before, like October, when people started thinking the Fed would take rates down. But there are a lot of good banks out there that trade around tangible book. And the reason I mentioned this is because if you think a good bank, pick your number, right? Let's say a good bank can do 12% return on equity. Right? That's nothing crazy. That is on any measure that's above their cost of capital, but that's nothing crazy. And let's say they pay out 6%, half of that is dividends, and they retain the rest of that to grow, right? Like you can 12% return on equity. If you buy and hold it, you're going to get basically a 12% return. But if you think over time, the multiple grows to like 1.2 times book value with capital returns, like it's not hard to paint a mid-teens or higher long-term return for buying that at tangible book. Now, we've made all sorts of assumptions there, right? But most of the investors I talk to, when I mention financials, say, I don't do financials, right? And one of the reasons I asked you this is because I know you've been in Ally for a while, and you and I have traded thoughts on Ally previously. Ally, for those who don't know, it's the old GM car financing unit. I think it's one of the few banks that Buffett still owns or Berkshire still owns. And I think it's very interesting when you say that because they own Ally and Capital One, which are both pursuing either branchless or branch-light models, which is kind of where they're unrelated. I'm off track. I guess do you think investors, when they dismiss banks, are dismissing a source of these letting winners run? Now, they're not going to be like huge grand slams, but if I said, hey, I could paint you a pretty easy picture to mid-teens return over a long hold period, that smashes the indices. A lot of investors are dismissive of that. And I wanted to ask you both on banks, but just on the general, like the financials mid-teens model, that is another one that generates a lot of wealth over time. That is basically what Buffett pursued in his late stage career. And I don't see a lot of investors talking about that. So I just wanted to ask that because I know you've looked at Ally and you've looked at these things before.
Well, I probably should have just got to the I don't know financials answer sooner. that would have made my life a little easier.
Cut me off earlier, Alex.
No, I think the point's fair. I mean, that's basic. It's largely aligned with what I see in something like Ally. I think if this works over time in terms of what I think they can do on the deposit base and in terms of how I feel about the asset classes that they play in, and a reasonable assumption in terms of capital return to shareholders and kind of the financial framework you laid out, I think that's correct, and I think it'll work well. It's also a business where, as we've seen over the last year or two, at every turn there's just a new thing to worry about, right? I mean, in their case, we've dealt with crazy runs in used car pricing, we've dealt with significant moves in interest rates, we've dealt with the regional banking issues and what impact that would have on the deposit base, et cetera. So we've gone through a number of tests, and for the most part, they've shaken out reasonably well. But I think it's probably fair to say that will not be the last test. So getting in a position where you're truly comfortable owning something like this and what that means in terms of position sizing, I think that's probably the important question to answer.
Yeah, no, they're just hard because look, banks are black boxes, right? And I think everyone worries you're going to invest in Lehman in 2007, where Lehman. I don't believe they ever reported a year of negative ROE. They reported 20% years ROE every year until 2008, they're bankrupt. And people worry about that. And I hear you on that. But, a lot of the newer examples, right? The First Republic, the Silicon Valley Bank, you could look at Silicon Valley's bank and it was right there on the balance sheet, right? Held to maturity securities. It held at 100, fair value 40. We have 30 billion of equity. I'm making rough numbers. So we're negative 30 billion in equity if you mark the things to market. Like, you can look at the banks, and I'm not saying like a Citigroup or a JP Morgan. They have so many assets. They really are black box from the outside. But some of these smaller banks, they're just like, hey, 50% of our loans are to commercial real estate. Yeah, you don't know the 500 loans that they did, but they'll give you high level stats on them. And I just wonder if investors are, because of fear of that, if they're cutting that off. On the other hand, when I talk to financial experts, investors, they'll throw out like 4 stats at me and stuff, or things I hadn't looked at, where like, oh shit. But being a generalist, sometimes that does happen. So I just wonder, investors are so hesitant to invest in a lot of these things if they're cutting themselves off. And I know in late 2022, a lot of investors would say, hey, we just saw the deposit run. This is why you can't invest in banks. And my counter would be, hey, if the banks survive the deposit run, like with COVID, a lot of COVID businesses, I like say, hey, COVID's the worst thing they're ever going to see. If they survive the run, like, to me, they might deserve a higher multiple now, not a lower multiple, because they've proven they can survive 6 months of zero revenue. Anyway, I threw a lot out there. Anything else there?
Yeah, I think the famous quote is, there's more banks than bankers, right? I think it's a business where you really need to feel good about the culture and the management team and what that all means over time. And, we had a very notable example in the industry of Wells Fargo in terms of culture and management team and incentives, a handful of years ago. Ally, in the last year or so, we've seen very, I would say, concerning issues in terms of C-suite turnover and the like. So it's, I think it's an ever-present part of the business. I think that's true everywhere, but it certainly feels more acute in financials, because, again, as you well laid out, a mistake can kill you. Whereas in other businesses, a mistake maybe means that you need to, adjust or do something to try to get back on track. So it's a business where you really need to feel confident in people that you can trust with your capital.
Last question I want to ask you. So we started this all with the idea of best ideas funds. And, best idea funds, as I've understood them, are, a guy says, hey, I've got 20 smart hedge fund managers, and all of them will come to me and be like, here's my number 1 idea. Here's my number 2. Here's my number 3. And what they'll say is, hey, I'm just going to go to my 20 smart hedge fund managers, and I'm going to take all of their number 1 idea. I'm going to put it into a fund and put a 5% weighting. And now I've got a best ideas fund, right? And isn't this better? Instead of investing in everybody's second best idea, you just invest in their number 1 idea. And I've heard this idea pitched a ton of time, and I think it fails every time. And because we're running a little long, I'll lead the witness. But I think they fail because the person who's putting them together doesn't have the conviction, right? Like, if I was putting a best ideas fund of Alec, and you were one of the people, if Microsoft was your idea in 2014, I would have been out in 2017, because I would have said, oh, thesis drift, right? He bought it at 10x, it's at 25x, thesis drift, I'm gone. You had the conviction to hold. On the other side, if you had bought Microsoft for 10x, and then it went to 6x, and you sold, and I had invested in your best idea on the cheap stock, I think I actually would have been doubling down, right? Being like, oh, this guy, he doesn't have the stomach. He can't handle the losses. So I would lead the witness and suggest best ideas funds don't work because the person running them doesn't have the conviction and doesn't understand the idea like the person who's actually putting the best idea on. But I would ask you, like, what do you think about that thesis? Where do you think it falls short? Do you think it falls short?
I think the way you described it makes perfect sense. I have no idea how these things are typically managed. My thought would be that the best ideas fund is just simply the collection of best ideas from the managers that are selected. Why you would then overlay your own decision making on top of that seems a little bit odd to me. I would think that it would be something close to equal weighted. But to the extent a manager was making decisions on top of that, I think that'd be kind of odd. And I would be a bit questionable that that's going to work well, particularly on a after fees basis. So I would have the same doubts that you have in terms of that being a particularly fruitful approach.
We're almost at an hour. We've covered pretty much everything I wanted to cover. Again, I'll include a link to the Letting Winners Run post, and I think there was one other post of mine that I put in there, so we'll include links to both of those. I don't know. We didn't really talk what's in your portfolio today. We'll just have to schedule the 5th one. 5-time guests get a Yet Another Value Podcast t-shirt, so you'll have that stuff forward to. But anything else you wanted to mention on this, or anything else going through your head these days?
No, it was a great conversation. Again, I'd tell people to go listen to your conversation with Bill Brewster over at the Business Brew. Well, conversation what number is it? 3 or 4?
For you?
No, you on Bill's.
I think it was number 3 with Bill. And Bill, I keep asking him, is that a record or not? And he hasn't responded to me. So I don't know if I'm the t-shirt winner there or not.
say he's got to get the t-shirts going. But yeah, I would say people should go listen to that conversation. And, I think those two conversations are probably opposite sides of the investing spectrum, but they're both very relevant in terms of, making thoughtful decisions and kind of figuring out who you want to be as an investor. And I think that's a huge part of this game.
Well, Alex, I really enjoyed this. This was different, but I had a bunch of fun. It was, as you hopefully could tell, I really enjoyed your post and I found it very thoughtful, and I was trying to really did a lot, and this helped connect some of the other dots for me. So really enjoyed it. Enjoyed having you on. Congratulations, almost. I think we'll probably have to take a 2 or 3 month hiatus before we can get you back, but looking forward to having you back on a little more sleep deprived, and we'll go from there.
Thanks for having me, Andrew.
Have a good one.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.